In 2018, the tax law changed dramatically. It is estimated by the Tax Policy Center that over $20 billion of donations that were going to come may not come because of this new tax law change. And that's really because of the change in the itemized deductions. And today we're having an accountant and a lawyer and myself, a financial advisor, talking about other ways you can still give to your nonprofit organization and receive a tax deduction.
The big sort of key changes with regard to income tax and charitable giving is, one, they've increased the standard deduction, so your itemizations have to be higher than the standard deduction. They've also eliminated a lot of things or capped a lot of things that people could itemize before. So it's harder to itemize and you have a higher threshold to get over.
Correct. I mean, the changes that affect most people with the itemizations, where they're reducing them, is number one, there's a cap on the amount you can deduct for your real estate taxes, personal properties, and state and local income taxes. The cap is $10,000. That will affect many, many people. In addition to that, there's no more miscellaneous itemized deductions. There's a number of limitations, or now they just eliminated many itemized deductions, which will eliminate many people from itemizing.
So I think for single people, they've got to get over a $12,000 number. And for married people, it's a $24,000 number.
That's correct.
So for single individuals, you have a $10,000 state and local tax limitation. That's your real estate taxes, as you were talking. They refer to that as SALT. That's not a hard threshold to get over if you live in the Northern Virginia, DC, Maryland area, because we have such high state taxes and real estate taxes. Most people, you only need another $2,000 in deductions, and that normally would come about from anyone with a mortgage. But if you're married, getting over that $24,000 number, I think, is going to be a lot harder for people to do.
It'll be a lot harder, and in addition to that, they've limited or reduced the amount of your mortgage interest, so that anybody that acquired a mortgage after December 15th of 17, the limitation is now $750,000, where it used to be $1 million. You will have your grandfathered in mortgages that were in effect before them, so the limitation isn't there. But it still globally will probably reduce itemized deductions for most people.
So you really want to help support the nonprofit organization that is putting this on for you. That's what we were all here to talk about. That really comes down to a number of different options, and Alan's described one of them. One is giving your appreciated securities. So you were smart enough and lucky enough to buy Amazon 10 years ago, and now it's tripled in value. And if you sold it yourself without giving it to a nonprofit organization, you would pay taxes on it, 23% capital gain plus your state tax. But if you give those securities directly to a nonprofit organization, they can receive them and there's no tax for you. So that's one of the very, very good methods. The second one, which Alan described, is lumping. So you can't get over this $24,000 standard deduction. So instead, you're going to put your contributions together. So you thought about giving $25,000 over the next 5 years. You're going to do it all at once. So you're able to take advantage of this lumping effect. The third one, which is very interesting, and I have clients talk about it all the time and complain about it, is if you're over age 70.5 and you have money in an IRA account, you're required by law to take a mandatory required distribution. Most of my clients hate it because they had this money all deferred from taxes, and all of a sudden now part of it has to come out every year. Well, if you give that money up to $100,000 a year to your nonprofit organization, you don't have to pay any tax on it. So that's even better, because you normally would have been taxed on it as income, both federally and on the state level.
So the reason that's important is because if you find yourself in the situation where you can't itemize, if you were to give to charity, you're not getting a tax benefit from that.
Correct.
However, if you have a required minimum distribution, you can give that to charity, and that way it doesn't matter whether or not you're itemizing, you will still get that charitable deduction.
Absolutely correct.
I think that's the key of what we're trying to do here. So if you want to help a charity and you're looking for ways to give, we want you to benefit from that as well. So the key is, how can you still give and get a tax benefit from doing so? And so we're looking at what are ways that you can still get a tax benefit and give to the charity. And as Mark discussed, one great way is if you have minimum required distributions and you give to charity, that's a great way to do it because it doesn't matter whether or not you itemize. Donor-advised funds is another example of how you can give a lot of money at one time and then spread it out over time. Donor-advised funds is like a private foundation. So if you were to set up a foundation, you get a lot of money, or you put a lot of money into it all at once, and then the foundation can, over time, give it to charity. A donor-advised fund is a way of doing that without actually setting up a foundation. So you get the deduction in the year you put all the money in, but then over time you can give it to the charity of your choice. The way a charitable remainder trust works, basically you put money into this charitable trust, and often we want to put highly appreciated assets into a trust like that because if we were to sell those assets in our own name, we've got to pay a whole lot of capital gains. But if the charitable remainder trust sells those assets, they can diversify and not have to pay any taxes. So one very nice tool is it allows for appreciation. Then we get a stream of income back during our lifetime. So that's what charitable remainder trust means. The remainder goes to charity, but you get this lifetime stream of income, which is very powerful for people that only need a set amount of money. They can put a lot into this charitable remainder trust, get a charitable deduction now, and get a stream of income. Mark, you mentioned community foundations a little bit. Can you expand upon how they work?
Yeah, so the idea is basically you can give a theme or and a specific target for your money. So I'll give you a quick story. We have a client that has now passed away, and she was working in the school system. And back then in the 1960s, surprise, surprise, you actually were not allowed to open up an account if you were a woman. You had to have your husband sign off on it. She wanted to make that change, and so her and a number of other women got together and opened a local credit union in our area, specifically for women. It's called the Apple Federal Credit Union, the Apple obviously for the teacher part. And when she passed on, before she did, she made sure that money was going specifically to women, no big surprise there, and those women were going to be able to get higher education. So that money that she gave is offering scholarships to children or adult children that go to school. So it's a huge benefit for them in the future. And that goes on forever. So if you're thinking about charitable giving, that's an excellent way to do it.
What are your thoughts on the big changes to the legacy planning, how you leave assets based upon the change to the estate tax law?
It affects the thought process, I think, on the gifting in terms of what you want to do during your lifetime. But it virtually eliminates many people from certain estate tax issues, especially with the portability.
One of the big things that I think will affect charities is, as an estate planning attorney, we always wanted to make sure things qualified for the estate tax charitable deduction. And there were a lot of requirements that you had to deal with to make sure that we qualified. But now fewer people are subject to the estate tax, so we don't care in a lot of cases whether or not we qualify for that charitable deduction. And what that allows is for much more creativity. If you want to leave a legacy to charity, you can put a lot more rules in place, you can have different remainders in place. There's a lot of things you can now do because you don't care whether or not it qualifies for that charitable deduction. So we can get much more creative, and I think that's going to impact how charities receive money in the future. We just want to commend this organization for allowing us to reach out to their donors and help advise them on ways to give to charity and save taxes while doing so.